What you see on your screen right now is a disclaimer. This is a standard disclaimer, and basically you should be aware that trading options does involve risks and is not suitable for all investors. Anything that you hear tonight or see tonight on the screen is not to be considered as investment advice. This is being offered for educational purposes, and you should certainly consult with your personal investment consultants before undertaking any particular trading strategy or technique. So market trends. There are basically three ways a market can trend. That's upward, downward, and sideways. I've heard people break that down into 5 directions, saying that there are strong bullish trends and weak bullish trends, strong bearish trends and weak bearish trends, and then sideways trending markets. And when we talk about sideways trending markets, what we're really talking about is consolidation. Our focus tonight is on bullish trends. And the reason we're focusing on bullish trends is that this is where the majority of investors try to make their money, is when markets rise. They can last for extended periods of time. In fact, they can last for years. And our goal, if we're going to trade a trend, is to basically jump on board the trend and then ride it for as long as we can. Now what you're seeing is a graphic that, if you have studied Elliott wave theory at all, you're going to recognize this straight off. But let me bring up on my pointer here. But what we have here is that you're going to see there's going to be a series of upward moves followed by a pullback. And every time there's an upward move, there's going to be a high made. It's going to pull back to a low, and then it's going to pick up with the next move in that trend. The important part here is that we have these higher highs, and we also have higher lows. The trend does not move in a linear manner. In other words, we don't have a straight line here, but we have a zigzag motion. The overall trend, however, is upwards. And one of the ways to define a trend is to look for higher highs and higher lows. When you fail to find higher highs and higher lows, then you want to start looking for a possible change in trend bias. At the top of your screen right now, you see a quote from John Murphy, who's a well-known technician. And it's really true. The peaks and the troughs, as John describes them, that's what defines the trend. Now, there's a lot of other aspects to it. We could talk about breakouts and impulse wave pullbacks, corrections. What's important for each of these is that there are ways to enter the trend that take advantage of breakouts, that take advantage of extended waves, that take advantage of pullbacks to areas of support, that take advantage of corrections. Trend failures are the times that you really want to try to stay out of the market, at least as a trend follower, that when the trend starts breaking down, that's a sign to exit. But what you want to be able to do is you want to be able to identify a breakout. You want to be able to identify when the market has bulled back to an area where it's safe to get in, because you don't want to do it when the market is extended, because when the market's extended, there's a higher probability of a pullback, which will likely shake you out of the position. All right. What we have now is we have a daily price chart. Doesn't matter what the security is, it's just a price chart. And what we can see on this price chart is a number of things. You can see things like, here's a low, here's another low, which is higher than the prior low. Here's a high, and then here's a higher high. These are the classic indicators of an upward trend. We can also draw trend lines that will tell us that we're in a upward trend. Also on this chart is, you can see here, this area here, the market is extended. And if you were to buy into this market up here, you would likely be shaken out during the pullback to an area of support down here, just in time for the market to resume its upward course. Right here you have an area of consolidation. For anyone who is a fan of William O'Neill, you should recognize right here is a cup with a handle, and here's your breakout bar right here. That's an area to get in. We're not going to spend too much time talking about technical analysis, but I want you to start getting a sense for what a trend looks like and what it looks like when a market has pulled back to an area of relative support where it's safe to enter versus an area that the market has extended and it's less safe to enter. Now what you should be seeing is a longer term chart. This is not a daily chart. This is a longer term chart of what I believe is the NASDAQ. And if you look back over here, each of these hashes right here, that's a year right there. So that's 1999, here's 2000, 2001, 2002, all the way out to 2006. And you're going to see a very steep upward trend here, which we all remember as being the tech bubble. It topped here in early 2000 and did not bottom until 2002. Now, if you were riding this as a buy and hold investor, you saw your accounts inflate significantly during the year of 1999 and into early 2000. And then you saw those accounts decimated, or actually more than decimated, by the time the market bottomed in 2002. And even though we've seen a bull trend emerge since that time, if you remember, we bottomed in 2002 here. We then really began our rally here. This was probably a wave 1, wave 2 pullback, and wave 3 here, 4, then 5, and we can do whatever counts we want, but we saw our 2003 rally. Market held up in 2004, 2005. We know that it continued to rally through 2006 and 2007. That is a very long rally. But despite that rally, we still never made it back up here. And the moral of the story is that if you're following traditional buy and hold advice, you're really putting yourself in harm's way when something like this occurs. You could make a lot of money here. You could make a lot of money here. You could make a lot of money here. But if you sat through the market here, it really didn't do you much good. And that's part of why we want to take a look at a little bit more intelligent, sophisticated way of approaching the market and try to avoid those big downward losses. One of the ways we can do that, or that we can kind of enhance our trading, is by substituting a call option for stock. But before we do that, we really need to understand what a call option is. And where a lot of traders get confused is that they start thinking, well, call option is like owning stock. And that's just not true. Call options are not like owning stock. They are not equivalent to stock. options, whether they're calls or puts, provide us with discrete components of risk. What do I mean by that? Well, what I mean is that we can take advantage of various aspects of a stock's upward move, downward move. We can take on risk. We can limit risk. And that's really what options are all about, is they let us break stock positions, either long positions or short positions, into its components of risk and reward. And then we can take on just those components that we want. So if we want to adopt a position that's equivalent to owning the stock, then what we're really talking about is synthetic stock. Synthetic stock is made by simply combining a long call option, which gives you that unlimited upward reward potential, with a short put, which gives you that unlimited downward loss risk of loss. You combine those two and you end up with synthetic stock. And as long as the call and the put are the same expiration and the same strike, that's exactly what you have. You have a position that is entirely equivalent to stock, but it has some different features. You have an identical risk to reward profile, but selling the short put finances the cost of buying the call. And this results in little or no capital outlay for taking on that position. So you could buy 100 shares of stock, or you could buy a call and sell a put, and you'll have the same exposure to risk and reward, but the cost of getting into that position is significantly less. You will have no more and no less risk than holding stock, and you will have no more or no less profit potential than holding stock. So if you're comfortable holding stock, then you should also be comfortable holding synthetic stock, because they give you the same exposure to the market. So here's a hypothetical of synthetic stock. You could buy 100 shares of XYZ at $50 per share. That's going to cost you $5,000 plus whatever costs are involved in the transaction, such as commissions, etc. Or what you can do is you could buy an at-the-money call and then sell an at-the-money put. And in our example here, we have a net debit of $55. So what you're doing is you're taking on the same risk, the same reward possibilities with the synthetic position, but you're doing it at a cost of $55 versus a cost of $5,000. So it's a very different cost structure. Now you'll have margin requirements on that short put, but that cash does not leave your account. And those margin requirements are going to be different depending upon what type of account you're trading out of and what your broker's requirements are. And they may be anything from a cash secured requirement, which means that you have to have enough cash to actually buy the stock. You'd need the $5,000 in cash in your account, all the way up to a very small percentage of that amount. Here's another hypothetical. All we're going to do is, instead of buying and selling the $50 strike, we're just going to move up one strike. And we're going to buy an out-of-the-money call, and we're going to sell an in-the-money put. Our risk profile is completely the same, but because the put is in the money and is more expensive, and the call is less expensive, we're now taking on that position at a credit of $4.45. So not only are we getting it cheaper than buying the stock, but we're actually going to pick up $445 of cash that's going to be deposited to our account when we take that position on. Now, I'm not here to tell you tonight that what you should do is, instead of trading stock, trade synthetic stock. but it's important to understand this basic synthetic relationship between stock and options before we get into selecting calls and adjusting positions. So let's remember, synthetic stock has all of the components of risk and reward. That's unlimited risk, unlimited reward. We are going to keep the risk and reward components associated with the call option, which is that unlimited upside potential with a limited downside risk. But we're now going to jettison, we're going to get rid of the risk and reward components of that short put, which is that unlimited downside loss. So we're going to end up with a very different risk profile now than we would if we just owned the stock. The benefits that come with the call option is that we now have significantly less downside risk. But there's a cost associated with that. And that cost is that we are now only going to participate in a portion of the upward move as dictated by the delta and the gamma of our call option. We're going to talk more about delta and gamma as we get deeper into this presentation, but what's important at this point is to understand that there is no free lunch here. If we use a call option for every 100 shares of stock that we would otherwise buy, we need to understand that for every dollar move in the underlying stock or exchange traded fund, we're only going to experience a little bit, a portion of that upward price advance. We are also now exposed to changes in implied volatility, which could be positive or negative. If volatility rises, we're going to see our call option move up in value. But if volatility falls, we could be hurt by that. We are also exposed to theta decay. Options are wasting assets. As long as we hold an option, we are losing value to the passage of time. So here are the basic characteristics of a call option from the perspective of the Greeks. Our delta is always positive. When we own a call option, we own positive deltas. So we will benefit from upward price movement in the underlying. Our gamma is also positive. And what that means is that as our delta moves, or as the price of the underlying moves higher, our delta is going to move higher. Excuse me for a minute. I had a cough there for a minute. Vega. Our Vega is also positive. And what that means is that if volatility rises, so does the value of our position. And if it falls, so does the value of our position. Our theta is negative, meaning that we're going to lose value with the passage of time. So we have a positive delta, we have a positive gamma, a positive vega, and a negative theta. So now we need to select our call option. We've made the decision we're going to use call options, but now we need to make a decision as to which call option are we going to use. And it boils down to two questions. What strike? What expiration date? So what strike? The two first things we need to have an understanding of is that we can move further away from the money and we can move deeper into the money. And there are, pluses and minuses to both. The further we get away from the money, the cheaper our option is going to be. But that cheap option is also going to come with a lower delta, which means that our participation in the upward price movement is going to be less. And it also comes with a lower probability of that option winding up in the money. And people, often call these, these far out of the money options. They'll call them lottery tickets, and the reason is because the odds of winning are very, very low. So we can get out of the money, we can get really cheap options, but the odds of those ever paying off are low. We can also move into the money, and the further we move into the money, the more expensive the option is going to become, because now we're not only buying time value, but we are also buying intrinsic value in the underlying. Our delta is also higher, so we participate in more of the price movement. We are also less susceptible to changes in implied volatility, because the implied volatility only affects time value. It does not affect intrinsic value. And the greater, and we have greater exposure to price reversals and breakdowns in the price, because that intrinsic value can be lost. So if the trend breaks down and prices fall, we're going to see the intrinsic value of our option fall as well. Changes in implied volatility can hurt us when we own call options. So before we buy a call option, we need to take a look at what's going on with implied volatility. We need to assess it. Is it high? Is it low? There are different ways to do this. You can look at historic volatility, which is where the stock or the underlying security has traded in the past, and compare that with what the market is saying is going to happen during the life of this option. And we can make a judgment call. Is this option fairly priced? Is it expensive? Is it cheap? We can also look at historic implied volatility. Where has implied volatility typically been in the past on these options? And there are various tools out there that let us do that. Now, we're not going to get too deep into this tonight, but if you're not sure how to assess implied volatility, that's something you're going to want to put on your to-do list. That's something that you're going to want to learn about. And it all comes down to a question of, do I think implied volatility is at a level that is going to be sustained for the life of this trade? In other words, it's not going to fall. Do I think it's going to go up? Do I think it's going to go down? You need to make some judgments in this regard. And ultimately, it comes down very much to a balancing act, that you're going to balance the risks of changes in implied volatility with your selection of a strike. And the more concerned you're about volatility falling, the more likely you're going to want to move deeper in the money with regard to your strike selection. And the less concerned you are about it falling, the closer you're going to get to the money. And if you're thinking that, volatility may go up a lot, then you can start making judgment calls about, whether you want to, take a look at other options that would benefit even more greatly from increases in implied volatility. But for our purposes, for trend trading, basically what we want to do is we want to just protect ourselves from a potential drop in implied volatility. And the best way to do that without selling an option against our call is to move a little bit deeper in the money. So what expiration? Right? The more time we buy, the more time we have to stick with the trend, the lower our rate of theta decay, at least during the early part of the trade. But the more we're going to be susceptible to changes in implied volatility, because implied volatility affects time value, and if we're buying more time value, if we own more time value, those effects of changes in implied volatility are going to be felt even more. So when we start looking at how much time to buy, what we're going to look at is, how long do I expect to be in this trade? And we certainly want to give ourselves enough time for that. And we probably want to give ourselves a little bit extra time. So we want to say, well, I think I'm going to be in this trade for 90 days. You might want to go out 120 days. You might want to go out 180 days. But the further you get out, the more time value you bring on, the more you need to be concerned about implied volatility. So again, if you are not comfortable assessing implied volatility, put that on your to-do list. I would take a look at, as a general rule of thumb, when you're buying an option in the context of following a trend, I would tend to stick with at least 90 to 120 days. It doesn't make a lot of sense in my mind to get anything closer in time, closer to in the way of an expiration date. You don't want a 30-day option. You don't want a 60-day option. Theta is going to be burning pretty fast on those. You're not giving yourself enough time for that trend to develop and continue. So I think you really need to look at least 90 to 120 days. If you can go out further without being uncomfortable with your implied volatility risks, take a look at doing it, but make sure it makes sense. Leaps do carry some significant IV risks. There are people who I know who trade leaps, and one of the things that they do is they look for deep in the money leaps. They buy a lot of intrinsic value, and the reason they do that, or at least one of the reasons they do that, is because that intrinsic value is going to help protect them against changes in implied volatility. Now we're getting into position sizing, the use of stops, and what all of this equates to is basically money management or risk management. Before I get into that, there's a couple questions that I'm going to address right now. The first question is, Chris, is this only useful for ETF or any index or stock underlying? The presentation tonight is applicable to, you can use it on stocks, you can use it on exchange traded funds, you can use it pretty much on anything that trades in the market that has options being traded on it. The key is that we're looking at trading in the trend. So you're not going to want to use these techniques for counter trend trading or swing trading or short-term style trading, but you're going to probably use them more with position style trading or any kind of longer-term trend. Carl asked me, I am receiving no audio. Is there a problem? Carl, you didn't see my sign here, so I'm going to bring up the sign for you. And here you go, Carl. Hopefully you can see this, and you'll be able to dial in and you'll be able to hear us. All right, one other question. We discussed on call option, but is there also any rules around selecting put option that we can sell? Selling put options is not part of tonight's discussion. There are a lot of ways to do it. There's a lot of ways I've done it. Let's deal with this presentation tonight, and then I'll think about maybe doing a put selling presentation for another time. But the short answer to it is that if you're trading in the trend, you want to take advantage of that price move, that longer term price move, and you're going to want to participate in that more than just a premium you're going to get from that put sale. So let me get back to where we were in the presentation, and then we'll move on. Okay, let me grab a couple more of these. Lindsay asked, I had problems installing the Citrix GoToMeeting software to attend the webinar, so I missed the first 15 minutes, so I can catch up later. Could you please email me a link to the download slideshow series from the webinar? Lindsay, I can't. The slideshow's not on the internet server, so I can't email it, or I can't link it, give you a link. But don't worry about it, because so far all we've covered is some basic concepts of technical analysis, and we've talked about call options, and hopefully you'll catch on, and hopefully this seminar will also be available for recording. Okay, so back to the task at hand. Position sizing. Options give us the ability to leverage, which means that we can control more stock with options than we can by just using cash or even by using a margin account. So where we might be able to buy 100 shares of stock, we could probably go out and buy a handful of options, of call options. Just because we can do something doesn't mean we should do something, though. And basically what you want to do is you want to apply the same rules of risk management that you would apply to owning, if you're trading stock, to trading options. And as a rule of thumb, you don't want to risk more than 5% of your account on any one trade. And preferably, as your account gets a little bit bigger, you want to limit that to 1 or 2% of your account. So, if you start out with a $5,000 or $10,000 account, just for practical purposes, you might go up to 5%. But as that account gets bigger, and you start trading with $50,000, $100,000, you're going to cut those position sizes back, and you're going to trade, 1%, 1% or 2% of that account. So, the idea that I would suggest to you is that if you're comfortable owning 100 shares of stock, then go with one call option. If you're comfortable, trading 200 shares of the stock, go with 2 call options. In other words, you're going to substitute 1 call option for every 100 shares of stock. Where the judgment call comes in is, what if you're going to trade 150 shares? Do you go with 1 option or 2 options? That's something that you need to decide on. The one piece of kind of food for thought that I'll give you is that whatever you decide to do it consistently. So if you're going to trade, if you're going to go with 2 options and kind of split it down the middle, and you're going to round up, always round up. On the other hand, if you're going to round down, always round down. You want to do it consistently. Stops. You need to take a look at stops. Not every trade is going to work out, and that's true no matter whose trading system you use, and it's true no matter how smart or good-looking or lucky or how good your karma is or anything else. Not every trade is going to work out, and we all know that intellectually, but for some reason we have a real hard time coming to grips with that, and and we tend to stay in trades a lot longer than we should. So the first question you need to answer for yourself is, what is your maximum permissible loss? And we've already talked that you don't want to put at risk anything more than 5% of your account, and preferably closer to 1 or 2% of your account. So that should be your maximum permissible loss, 1%, 2% of your account. Certainly nothing more than 5%. So then you have to take a look at, well, what is the position size that I'm trading? If I add up the call options and the risk that I have in the market because of buying those call options, does it exceed my permissible loss? If it doesn't, then one of the things you could do is you could say, you know what? My stop loss is the value of my options. And if they expire worthless, that's my stop, I'm out. Right? On the other hand, if the value of the options exceeds your maximum permissible loss, then you need to put a stop in. And I try to do this a lot of different ways over the years, and what I found works best for me is that I put an order in based on the value of the option. So let's say I have a $5 option and I'm willing to lose $2.50. So I will then tell my trading platform to execute a market order if that value falls $2.50 and get me out of that position. And in market orders, typically I will not use them with options. One of the exceptions is on a stop, because the stop, the way the metaphor I use to describe it is, this is like pulling the ripcord or the lever for the ejection seat on a fighter jet. Your plane is headed into the ground, your trade's headed into the ground, and all you want to do is get out. And so you're going to pull the ejection seat lever and get yourself out. It is always your responsibility to establish your stop, and you need to do that before you get yourself into the trade. There are so many times when people don't do what they're supposed to do, don't establish a stop, and then we get the questions of, well, gee, I bought these call options and they've gone down in value 90%. How do I fix it? And the short answer to it is, you can't fix it. And that brings us to adjustment strategies. Adjustment strategies, or adjustments to option positions, people think of these things as some kind of magic wand or magic eraser that can fix all of our mistakes. And it's just not that. It doesn't work that way. They're not these magic wands that we can wave over a bad trade and make it into a good trade. What adjustments are, and this is just my philosophical perspective. Adjustments are planned trade modifications to respond to changes in the market. In other words, when we open up a position, we can say, okay, this market's going to go up, it's going to go down. These are the different possibilities. And if this happens, I'm going to do this, and if that happens, I'm going to do that. So, for example, one of the things we might do is we might say, hey, look, if this market goes down, I'm going to get out. I'm going to use a stop to get me out of this position if it breaks down below this point. On the other hand, if it trades higher, then I'm going to execute this adjustment to lock in profits at this point. So that's the way I look at adjustments, at least in the context of trading these call options. The bottom line for me is that every adjustment needs to address a particular purpose, and if it doesn't address that purpose, then there's no purpose in affecting the adjustment, because you're not getting the benefit of making it. So if a trade goes bad, it goes bad. Get over it, close it, and then move on. You're going to spend more time, more effort, more emotional angst, more money trying to fix a bad trade than it's worth. Because the moment you close that trade, you're now free, both physically, your time your attention, your emotions, you're free to go and look for other trades, look at other opportunities. Your capital is freed up. You're now able to reinvest it somewhere else. You invest it in a good trade rather than trying to fix a bad trade. So if a trade goes bad, close it and move on. I don't suggest sitting around trying to think of some creative adjustment that will fix it for you. Just close it and go with another trade. If a trade goes well, however, now we have opportunities. We have opportunities to start reducing our exposure to risk. We have opportunities to lock in some profits. And we have opportunities to continue riding that favorable trade as long as our stock or our exchange traded fund continues to trend as we expect it to. I have a handful of adjustment strategies for you. And the first one is simply a bull call spread. So, doesn't sound sexy, but this works, and we're going to talk a little bit about it. And this is probably where you want to start taking some notes about the different adjustments here. Basically, the condition where this works is the trade. We bought our call option. The markets continued to trend, and the trade has basically developed as we've expected it to. The market has moved higher. Our call option has appreciated, and the trend is, and we expect the trend to continue moving higher. But we want to start eliminating some of our risk. We want to take some of our money off the table, possibly lock in a small profit, and still be able to participate in further upward movement. And so the adjustment we're going to make is simply sell a higher strike call against our long call using an option with the same expiration date. We're basically just going to roll into a bull call spread. So here's a hypothetical. The original position, and this, it's a hypothetical original position. We have XYZ that was trading at $50 per share. We bought a $45 in the money call option with 120 days left until expiration, paying $7.30. Our maximum risk in the trade was $730 per option. You can compare that to a purchase of 100 shares of XYZ, which would have cost you $5,000 plus whatever transaction costs are involved. So XYZ does what we expect it to do, and it goes up. And now it's trading at $57 per share. We have 105 days remaining on our option. Our call is now worth $13, and we expect XYZ to continue trading higher, but we're getting a little bit nervous, and we want to reduce our risk and give ourselves that breathing room so we don't have to worry about losing money. So here's the plan. We're going to sell the $55 call, and we're going to sell it for $5.70. The risk of our trade is reduced from the $7.30 down to $1.60, so we're now risking just $160. We're risking that $1.60 to make $2.70, which equates to 169% return. And our maximum profit, based on the original investment, is $2.70 or a 37% return. Not all that exciting, but 37% is still 37%. And something to make note here of is bear in mind that synthetic stock, it's a long call, short put. Well, think of collaring your stock, putting a collar on your stock. So, how do you collar a stock? Well, you buy a put and you sell a call. So if we buy a put, that knocks out or negates the downside risk of the short put in synthetic stock, which leaves us now with a call option. And if we then sell the higher strike call, we're in a collar. So what we basically just did is the equivalent of putting a collar on our stock position. So that's our first adjustment, and I've got an alternate here, an alternate approach to it. We could sell the $50 call at $8.95, and that would eliminate our risk of $7.30, and will guarantee us a profit of $1.65 or 23%. So we're now on a guaranteed return of 23%. If the market tumbles and options expire worthless, we'd still keep the $1.65. On the other hand, if the market rallies to ever higher heights and we reach expiration, we could still close out that 5-point spread for $5, or a maximum of $5. So we could return up to 91% of our original investment. So there's an alternate approach to it. Adjustment strategy number 2. This gets a little bit sexier, a little bit more involved. You need to be a little bit more sophisticated in the way you handle your options. But basically what we're going to look at is we're looking at a market condition where the trade is developed just as we expected, with the market moving higher and our call option having appreciated. The market appears to be a little bit extended and due for some short-term consolidation before moving higher. Okay. The purpose of going diagonal would be to reduce our capital investment and enhance our profits by selling short-term premium, which would be the front month or maybe two expiration periods out at the most. But basically, we're going to be selling front month options. And what we're going to do is we're going to sell those front month options on a ratio of 1-to-1. In other words, one short call for every long call we hold, or less. So we don't have to sell 1-to-1 necessarily. Let's say we own 10 call options. We could sell 5 call options. That brings in premium, but it also leaves 5 of those calls unimpeded. So here's a hypothetical demonstrating a diagonal, or the use of the diagonal. Again, our original position is the same. XYZ trading at $50 a share. We buy the $45 call with 120 days left for $7.30, which gives us a maximum risk of $730. XYZ does what we think it's going to do, trades up to $57 a share. Our call is now 13. We expect XYZ's momentum to slow a bit after having made this advance. And we want to offset some of our risk and possibly enhance our return a little bit. So the plan is to sell a near month $60 strike call option. And we're going to do that out of the money in front of the market, and we're just going to bring in $1. So what we've done is we've reduced our original investment from $7.30 to $6.30. If the market falls from there, our maximum loss cannot exceed $630. If the market rallies beyond $60 and both options start trading at parity, which would be the worst case scenario for an upside move, what we have is a 15-point spread, which will be closed for $15, which would generate a profit of $8.70 for a 190% return on risk. So that's our worst case upside scenario, and our worst case downside scenario is that we've reduced our loss to $630. if the short option expires worthless, or if we're able to buy it back for less than we brought in when we sold it, we've then successfully reduced the cost of our trade. We've reduced our risk. And then we can continue selling near-term premium or front-month premium. And we can continue doing that out in front of the market, which means that the market has to move higher in order to take our short option in the money. And in doing so, it's going to have to put more intrinsic value into our long option. And so we can throw these options out there in front, let the market push us higher, and we can continue to ride that trend, bringing in front-month premium. Strategy number 3, rolling our call option. Market condition here, again, the trade has done what we've expected. The market's gone higher. We expect that the trend is going to continue, but we're concerned that a reversal could occur and wipe out our profits. Think of a highly, a market that's, extended significantly in price, and now we're thinking, geez, is it going to top at some point? Is it going to turn around? What do I do if that happens? How can I protect myself? But on the other hand, things look like it's just going to keep on going. And if it's going to keep on going, we want to be there to take advantage of it. So our purpose in making this adjustment is going to be to lock in profits while still leaving our upside unimpeded. And the adjustment that we're going to make is we're going to sell our now deep in the money call, and then we're going to buy a higher strike call. The original position was opened when XYZ was trading at $50 a share, and it's the same hypothetical here. We buy the $45 call with 120 days until expiration for $7.30. Our maximum risk is the $730. So XYZ does what we think it's going to do. It's gone up to 57 bucks. We're trading at $13, and we expect the trend to continue, but we want to lock in some profits for now to protect against a downturn. But we still want to ride that trend. We don't want to sell calls against it and risk having those go in the money. So here's the plan. We're going to roll our call from the $45 strike up 10 points to the $55 strike. The sale of the $45 call will net us the $13, and we're going to spend $5.50 for the $55 call, which will produce a net credit of $7.50. By bringing in that net credit, we have, quotes, locked in a profit of about 20 cents. We have maintained a relatively high delta of 0.6 or 0.7 because we're still in the money. And if the trend continues, we're in a position to profit from it. If the market falls, we have eliminated any risk that we have of losing money, and we have guaranteed ourselves a small profit. Now, there's nothing that prevents us from doing this again. So if the trend continues, we can roll up again. All right, now there are costs involved. You have commissions each time you do that. You're going to have slippage each time you do that. So you don't want to do it all the time. I think of it sort of like refinancing your house. You want to make sure that the benefit you get from the lower interest rate when you refinance your house is going to offset the costs of doing it. And that's the same thing with rolling your call here. Is you want to make sure that the benefits are justifying the expense. So, adjustment strategy number 4. Okay, this is selling a bear call spread. Now, market conditions here is, again, the market's done what we expected it to do. And we're expecting now a short-term consolidation or pullback, but we expect the trend to resume. We want to offset some risk of loss. We want to enhance our profits a little bit. So what we're going to do is we're going to sell a bull call spread in front of the market. Here's the hypothetical. it's the same hypothetical that we started out with, which we have an XYZ trading at 57 a share. Our call is trading at 13 a share, or $13 for the contract, and we expect the trend to continue, and we want to continue riding that trend to new highs, but we want to pick up some front month premium. So the plan is to sell a 62.50 bull call spread. That's a 2.5 point vertical spread. We're going to sell that in front of the market. Remember, the market's trading at $57, so we're going to sell this basically 3 points ahead of the market. I priced it using an options calculator. So these, I'm not just making the prices up. They're based on they're kicked out under the Black-Scholes model. So we have this 2.5 point spread that we're going to sell for $1. So we're going to reduce our risk by $1. And if the market falls, the spread expires worthless, which allows us to keep the $1 credit, and we've reduced our risk. On the other hand, if the market rallies up to 62.50 or beyond, which is which would take our credit spread all the way in the money, so we would experience a maximum loss on that credit spread. If that were to happen, we would have a $150 loss on that credit spread, which is our maximum loss. But in going that high, the market would have pushed into our long call $550 of an intrinsic value. So there's no way we're going to lose money on the upside. Even if we experience a max loss on our credit spread, we're going to make more than make up for that on our long call. On the other hand, if we're right and the market is going to consolidate a little bit, pull back a little bit, we're going to make some money by having sold that credit spread. Combining adjustment strategies. Now, these adjustment strategies that we've covered, these are, you don't have to think of these in a vacuum. You can actually put them together, and I've given you a couple examples here. So example number one is our bull call spread. Now, I've already talked to you about the idea that what you're doing with a bull call spread is the equivalent of putting a collar on your stock. The strategy pretty much stands on its own. It's not easy to combine this adjustment strategy with any of the others. However, if you collar the stock and you see the market pull back, so think of you have this this overextended market. It pulls back to its 20-day moving average, pulls back to its 50-day moving average, and seems to find support there. One of the things you can do is you can buy back that short call option, producing basically locking in the profit on that short call, and leave your long call in place. You're not going to increase your risk beyond what it was originally, or at least if you wouldn't want to do that. But you can basically trade in and out of that short call and the bull call spread. Example number two, diagonal spread. You can combine this with rolling up of your call option. And where this makes a lot of sense is if you sell your front month calls, the market goes up, and you have to buy those back, but you don't want to close out your long call. Well, what you can do is you can roll that long call up to a higher strike, producing enough credit to pay off the cost of buying back those short calls. And the other thing to think about with the diagonal spread is if you have multiple call options, think about, instead of selling a 1-to-1 ratio, think about doing it on a something less. Maybe sell one call option for every 2 you own. That way you can do things. First of all, you never really cap your upside, and secondly, you can sell additional call options when you roll. In other words, if you have to buy back your call options, you can buy them back, and then you can sell 2 in the next month for every 1 you bought back. So that's another way to look at it. But also rolling up the call when you need to buy back those call options, that's very effective in financing that trade, because you're basically locking in profits as things move higher. Example number 3 is the bear call spread. You can combine this also with rolling your call. You've just made a bunch of money because the market moved higher, and even though you had a max loss on the bear call spread, like we talked about, you've experienced a significant amount of appreciation in your call option. Well, you could close those vertical call spreads, but even though you've had that appreciation in your call, it's still susceptible to loss if the market reverses. So one way to make sure you get the benefit of having sold those vertical spreads is to roll your call up, bring in enough credit to justify that expense of that loss that you just took on those verticals. This gives you you still have continued upside profit potential. You've enhanced your front month premium collection, and you're basically just going to roll those calls to lock in the profits from the price advance while offsetting the losses of the vertical spread. That is also a very effective combination of adjustment strategies. This is kind of a bonus module here. This isn't an adjustment, but I'm going to profile a trade for you. It's going to, and as we go through this trade, you're going to see adjustments that I've made on a trade that I was trading last year. But when I opened the trade, I actually used out of the money options. And the general advice that I hear is don't use out of the money options. You either want to use at the money or slightly in the money options. And I don't disagree with those statements, and I don't disagree with the thinking behind them. But options give us a lot of choices, a lot of flexibility, and it pays to think outside of the proverbial box sometimes. So when we have an out-of-the-money option, what it means is we have a low delta, which means we pick up less appreciation when the market moves, and that the probability of the contract ever being in the money is relatively low. Now, if the market moves higher, that out-of-the-money call is certainly or quickly going to become an at-the-money or an in-the-money call. Our delta is going to go up when that happens. Out-of-the-money options are all time value. You're subject to theta decay. You're subject to changes in implied volatility. And you'll hear the label of lottery ticket applied to them because the odds of winning are low. But nonetheless, they exist, and they exist for a reason. Remember, every time you sell an out-of-the-money call against your stock or as a vertical spread, somebody's buying it. Someone's taking the other side of that trade. And there's a good reason to do it. So the way I've done it, and the way I'm going to talk to you about doing it, is instead of just buying an out-of-the-money call, we're going to buy a cheap call calendar spread. And when I say cheap, I put it in quotes because I'm not necessarily talking about going out, into the far reaches of the solar system, but I'm talking about moving out a few strikes, and we're going to buy a call calendar cheaper than it would cost us if we were at the money. And something to think about here is people typically think of calendar spreads as range-bound strategies. And the trade I'm going to show you is actually a very bullish trade. The benefit that this trade gives us, this out-of-the-money call calendar, is that we get into the trade for a relatively low initial cost, and we let theta finance a portion of that purchase. Because we're selling a front month option, our theta is actually going to be positive. If we had just bought the call, we'd have a negative theta. Here we're going to have a positive theta. Using a strategy like this can be very helpful when you're looking at buying a call option, going long, but you're just not comfortable doing it. Perhaps options are very expensive. Perhaps you're not comfortable taking on a position that large. So we're going to move out a little bit, get a little bit cheaper, and we're going to use some front month premium to finance that purchase. So here we are. We're going to go back in time to May 25th, 2007, almost a year ago. And what you're looking at is a daily price chart of OIH, which is the oil, excuse me, the Oil Service Holders Trust. And what you should see here is that this has been trading in a nice 45-degree upward trend for a considerable period of time. And I've got a trend channel there. You're going to see a horizontal red bar at the bottom and at the top. And what those horizontal bars represent are the profit zone for the call calendar. So anything below that red bar is going to be a loss. Anything below the bottom red bar is going to be a loss. Anything above the top horizontal bar is going to be a loss. Anything in between those two, that's our profit zone. The vertical red bar represents the expiration date of the front month option. So what we're looking at is we're expecting this ETF to continue trading on its trend, and we're expecting it to move higher as it gets closer to that expiration date. And we expect it to be right in the heart of our profit zone. So here's our trade date on the Oil Service Holders Trust, May 29, 2007. OIH was trading then at that's a misprint there. It wasn't 16.54. It was I think 166.54, something like that, between up to 168.14. So what we did is we bought the June-October 175 call calendar spread, and we paid a debit of $8.20 for it. That may seem expensive, but imagine buying an at-the-money or an in-the-money call. It's going to be a lot more money. So here is a snapshot off the Thinkorswim Analyze page, and this is what our risk curve looks like. And I imagine most everyone is familiar with the risk curve, but let me get a different color here that'll show up a little bit better. But this green line here, that is the profit or loss at expiration. This hash line here, right, is trading at 166.57. That is the price of OIH. As it moves up here, the price gets higher. If the price moves lower, it moves this way. This white line here, that represents the current day. So if we move higher to 170, right here, we're going to get a little bit of a profit in there. But that's what our risk curve looked like. And basically, if we traded lower, we're losing money. And if we traded higher, we're going to try to get it right in this sweet spot here. So these are excerpts from my trade diary. Now this is June 11th, 2007. OIH has done basically what we expected it to do, and it's traded higher, and it's trading just shy of $170 per share. So we have to start looking at rolling our short option, and we're going to roll it what I call it up and out. You're going to roll it to a higher strike in the next expiration period. And what I was looking at doing is rolling from the June 175 call to the July 180 call, and I wanted to do it for a credit of about $2.10. The trade was going for about $1.90 as of the 11th. So I either needed to see OIH move a little bit higher and or watch theta erode the front month call a little bit more in order to get the credit I was shooting for. The adjustment was designed to maintain a bullish bias. If I just rolled, if I continued the calendar spread, which means that the strikes remain the same, both the long and short strike stay at the 175 level. If I was just going to roll out to the 175 level, my concern was that if the trend continued, I was quickly going to see our delta on the trade turn negative, and that was going to defeat the purpose of the trade, which was to jump onto this trend and ride it. So I really needed to go up to a higher strike, and so I pretty much had figured out what my adjustment was going to be. So here we're back to the price chart, and what we're looking at here is I got to change my color again because I know that white just ain't going to show up there. So what we have right here is this is the contemplated short strike, the 180 strike. So that's what I'm looking at selling. This vertical red line here, that is July expiration. This is the June expiration. So we're really close to June expiration. This is our trend channel here. What I put in here was a Fibonacci retracement, because what we're looking at is these fours here. This is my trade software projecting out a wave 4, possible wave 4. So what I was looking at is, well, if this trade breaks down, what are the possible or the likely areas where it's going to stop, where it's going to pull back to, and what I was looking at was down here at a 50% retracement, 0.618. Those are the Fibonacci levels. In any event, those were things that were on my mind. My expectation was that the trend would continue. However, if it didn't, I was looking at what is likely to occur if the trend doesn't continue. So anyways, I expected it to keep going higher. I wanted to sell the 180 strike, and that's basically where I was at as of June 11th in terms of my thinking. So June 14th comes around. OIH had rallied. The order for rolling the June 175 call up and out to July 180 call, that got filled for $2 credit. So I didn't get the $2.10, but I got $2. This took the original, the original position was open for $8.20. So now my risk in the trade was brought down to $6.20. So rolling to that higher strike left me positioned to benefit from continued upside trend movement in OIH. The value of the position was, as of June 14th, was now at $9, which represented a $2.80 profit. So I had reduced my risk to $6.20. I had $2.80 profit in the trade, and my adjustment was affected. So July 20th, 2007, OIH continued in its rally, and my $180, my July call was now in the money, which is all right because we're in mid-July now, and we're looking at making our August adjustment. So we're rolling from the July 180 call, and we're going to go up and out again for what looked like about $1.60. And the trade got, the cost of the trade was now brought down to $4.60. The position value was now worth $12.50, which was over 50% return from the original investment. And things continue to look good. So July 20th, we're continuing on this diary entry. In addition to rolling that front month option, okay, and just this is the diagonal spread. This is the adjustment method or adjustment strategy 2 that I've been talking about earlier. This is what we've done now a couple times. We've opened up, we've gone from the call calendar to a diagonal. Now what I'm looking at doing is bringing in another adjustment method, which is to roll the call up. So I'm beginning to contemplate adjusting the $175 call option, which is now more than $13 in the money. And the whole idea is I just want to take some money off the table. We've had good success with this trade. I'm profitable. I'm happy. But like they say, bulls make money, bears make money, but pigs get slaughtered. So I'm trying not to be a pig, and I'm trying to take some of my money off the table here. But I still want to stay in the trade. I don't want to give up more, future profits. I want to stay in the trade. So here's what I started contemplating: is we're going to roll the October 175 call, and we're just going to roll it up 10 points to 185. And we're going to do it for at least a $6 credit. That takes our cost basis down to $4.60, or our cost basis was $4.60. So by bringing in $6, what we do is we eliminate the risk of loss, and we guarantee ourselves a pretty decent little profit on this thing. And we still preserve our upside profit potential. Now, there is no free lunch, though. And whenever we make an adjustment, there's always going to be a cost associated with it. So the downside to rolling up is that we're now giving up all of our intrinsic value in that long option. The long option position is now going to be comprised of basically time value. And it's going to suffer a higher rate of theta decay, and it's going to have a lower delta. But the upside is that any increase in implied volatility will push the at-the-money contract up higher in value. And because the implied volatility at that time for OIH was low, I wasn't worried about getting hurt on an IV crush. In other words, I wasn't worried about implied volatility falling because it was already pretty low. So I figured if implied volatility does anything, it's going to go up. And unfortunately, if it goes up, it's probably going to go up because of a pullback in the stock. So July 25th, we execute the roll from October 175 to the 185, or to the from October 175 to the October 185. So we roll up 10 points on the long call. I get $6.10. My trade is now risk-free with a guaranteed locked-in profit of $1.50. So if all heck breaks loose and OIH implodes on itself, I'm still walking away from this trade with a $1.50 profit. So rather than taking you through all of the remaining adjustments, which are just basically, I kept rolling that front month contract. I continued managing it, rolling that front month contract out until September 20th, 2007. Right? Remember, these are October contracts, so basically, I brought it within 30 days of those contracts expiring. So on September 20th, I closed it. I had a $9.50 profit on the trade. That represents 115% on the original trade capital over a period of 4 months. In my book, that is what I think of as a successful trade. That's pretty much an uneventful trade to me. I mean, my short options went in the money. Sometimes I had to manage it, but it's all according to plan. And I executed my adjustments not because I made mistakes. I executed my adjustments because I wanted to affect specific purposes, which were locking in profits, reducing risk, these sorts of things. So that brings us to the end of the presentation, save for our questions, and I'm going to start bringing those up. So Lindsay says, thanks for your reply. So would you please be sure to show us how we can access the recording when your presentation ends? Here's how the recording works. I have it on record. I'm hoping it records. This presentation is going to be, the idea is that it's going to be recorded and actually offered for sale, and I haven't really figured out prices or anything like that through the website. The folks who are here tonight from having bought the ETF Profit Driver, I'm going to include whatever recording I come up with. I'm going to include that for you. For the $15 that I charged to attend tonight, basically the presentation is that's it. For $15, that's I can't afford all the back end work. You guys would be amazed at how much time this stuff takes to just make sure everybody gets their stuff and downloads it and doesn't have problems and support it and all that kind of stuff. So anyway, that's the deal. Is that I hope you guys took good notes. If I can, I'll try to get a video out, and maybe I can work out something like a discount or something like that. But we'll figure that out. Cross that bridge when we get there. Another question, Chris, do we need to place stop based on underlying or just on the options price? You can place a stop however it makes sense to you. The important thing is that you have thought through the process and that you've actually placed the stop in a way that makes sense. The way I do it is I place my stops now based on the option price. In other words, I'll say, okay, on this call option, I'm willing to lose this much. Now, having said that, what I do is I look at the price, the price chart, and I ask myself, where is this stock likely to go, and where is this stock not likely to go? So, for example, if my expectation is that the stock's going to trade above the 50-day moving average, I don't want to set a stop that's going to take me out of my call option position, even though the stock is above its 50-day moving average. So I basically pull out my option pricer, and I pretty much do this on the Thinkorswim platform. I just plug the numbers in, and I figured out, okay, if it falls in value to the 50-day moving average, how cheap is this option going to get? And I make sure that my risk tolerances are consistent with that. And but that's the way I do it. Is I say, okay, if this option falls in value to $2. That should give me plenty of room between the 50-day moving average where I think it's going to stay above. That's my stop. So then I place that order as a good till cancel order with Thinkorswim, and go about my business. And I'll adjust that over time, so it's not there forever. Ira Maltz asks, with so much time remaining, why not do a calendar instead of a bull call? Excellent point. And the bull call is one adjustment. I don't use it a whole lot. If there's a lot of time left, typically I'll use it 30 days, 60 days, somewhere in that area. A lot of times I'll just close the trade if we get that close in. The bull call spread, it's like putting a collar on the stock. It's not something that gets real sexy. My guess is that most people are going to use it infrequently as an adjustment under these types of scenarios, and they're going to look for other ways. I think people are going to probably look at rolling things up. They're going to use diagonal spreads, that sort of thing. That's just my experience. But you're absolutely right, Ira. Why would you want to use a bull call when you could do other things to limit your risk? But ultimately, the question is that a bull call spread under these circumstances, if you can lock in a guaranteed profit, some people are going to like that security, and they're going to say, look, this is good for me. I'm going to guarantee myself a minimum profit. If things continue trending up, hey, good for me. I'll make more money, but I just don't want to sweat it anymore. Okay, in a roll call adjustment, do we have to do two separate trades or simply as a spread? Okay, when you're rolling, I'm assuming we're talking about the front month options or rolling the back month option up, that sort of thing. You can do it as individual trades if you want to. I suggest placing it on one order ticket. If you have an option broker that knows their stuff, all of them now have the ability to submit multi-leg order tickets. So you're basically put on one order ticket, and the trade will get done as one trade at one time for one price. Did you mean to sell a bear call spread? The slide said bull call. I was selling. If I was selling it, it was a bear call spread. So if the slide said bull, the slide was wrong. That was my mistake. Thank you for pointing that out, Ira. I will go back and check on my work. Okay, Chris, all adjustments are done considering that we keep the long in the money call always, right? The answer is yes, except when we're rolling the long in the money call up to a higher strike, which may be an at the money strike. So yes, those adjustments all assume basically we're working around that long call. Please give example. I think hopefully I cover that example. If not, put another question up there and I'll get to it. Ira asked, do you still use Advanced Get? Yes, I do. Not that I trade the Type 1, Type 2 trades, but basically that was a trading platform or my technical analysis platform that I bought years ago. I have not upgraded it, but I continue to use it. You can use any trading software you want. The Advanced Get's fine. If I had it to do over again, I probably wouldn't buy it just because it was expensive. And you can get most of the studies on other platforms. But yes, I still have it and I still use it. Chris, what if we had some pullback of OIH? And how do you handle it? Any thoughts? Yeah, the thought is that you have to have a point in your mind, right? And hopefully it's more than in your mind. It's in your you've written it down. That if the trade breaks down, I'm out. That's it. And the bottom line is when you get into the trade, you get into it for a particular purpose. If you get into it because you're following the bullish trend, if you're trading that trend, and the trend breaks down, the reason you got in, it ain't there no more, right? It's all over. So why are you still in the trade? You got to have a point when these trades get closed, and the trends do change. You will have reversals. Sometimes those reversals are really just consolidations, and you have to decide in your own mind what your rules are for differentiating between a consolidation, or in other words, how much of a pullback am I willing to tolerate before I get out, these sorts of things. All right, Carl asks, would it make sense to have a similar seminar with a deer market bias? I'm assuming that, Carl, you meant to ask me about a bear market bias. Yeah, it would make sense to have a similar seminar. The difference, though, with bear markets is that bear markets tend to be faster and more vicious than bull markets. And we can talk about affecting these adjustments, but they're not as easy to do. on bear markets. Anyways, yeah, I'll take a look at doing that. I'll think about that. Lindsay asks, fair enough. A discount for the recording would be greatly appreciated since I have no way to go. Yeah, no, I always try to make things make sense and be fair for everyone. I wanted to keep tonight's seminar. I needed to charge something for it because the guys who bought the course, it just wasn't fair for me to give the seminar away for free. On the other hand, I am new to this webinar technology. I'm still learning how to work the software and all that kind of stuff. So I didn't want to charge people a lot of money, and so I charged a token amount, and I'll make it up to the ETF Profit Driver people by giving them the video, and the people who paid the $15, for the fact that you took the time to trust me with the $15 and show up for the presentation. I've got everybody's email addresses, so as soon as the video's ready, I'll work something out. Any other questions? Let's see. Randy asks, do you always start with a call calendar? No, I don't always start with a call calendar. On the OIH example I did, and the reason I did, although I'm thinking back about a year now, is that I didn't want to spend the money that was involved with buying an in the money call option. It was pretty expensive, and the trend was already well established, and I just thought, what, if this trend continues, great, I'll be in it. But if it doesn't, if it breaks down, I don't want to sink a big chunk of money into those call options. So that was a decision I made during my trade planning process. One of the things to be careful about, by the way, there are folks out there that it's like, I'm a covered call trader, or I'm a call trader, or I'm a credit spread trader, and they get focused on one option strategy. And what I'm going to suggest is that rather than getting locked into, I always trade call calendars, or I always trade credit spreads, or I always trade iron condors, take a look at what's happening, and then reach into your bag of tricks and find the tool that best fits the situation. So if a call calendar makes a lot of sense to you, terrific. If buying just a straight call makes more sense, great. If selling a bull put spread makes more sense, terrific. But have at least several different tools that you can pull out of your bag of tricks and to make things work. Another question: please discount for people who attended today who did not take ETF like me. Okay, I think I already talked about that. Carl asks, would you please recap what the course is and its cost? I assume, Carl, you're talking about the ETF Profit Driver. The course is no longer on the market. It's been sold out. It's a course by Bill Pullis. And what it is that it's designed as a method of trend trading exchange-traded funds. It's specifically designed for exchange-traded funds. And the idea is that this was, the thinking behind it was that this is something that someone might want to use in their, IRA. Some 401k plans give you a brokerage option, but you can't really sell short in these accounts, and it's just a little bit more kind of a conservative approach to things. And so what Bill did is he back tested this thing, and he came up with 4 methods of entering and exiting the market. And basically he starts out with one method that identifies breakouts and puts you into the market during a breakout. There are a couple methods that when the market is in the middle of the trend, that you're going to get in when the market pulls back to a relative area of support, like we talked about, the 20-day moving average, the 50-day moving average, these sorts of things. Well, it's an easy thing to say, hey, you know, when it pulls back to the 50-day moving average, let's get in. But it's an entirely different thing to actually do it. You really need to have some rules in place that say these are the conditions that I will enter the market on, and these are the conditions where I'm not going to enter the market on. So you know, that's what Bill did. Is he put these trading methods together. They're complementary, so you have, you know, a way to get in on breakouts, a way to get in when the market pulls back. You have a way to get in when the market resumes its trend after consolidation. He, you know, put in a comprehensive money management system. Money management is something that I've learned primarily from Bill Polis. When we talk about like the practical nuts and bolts of how to do it, Bill's the guy that I've learned from. And the only thing I've done is I've taken his trading systems, or at least a few of them, and I've adapted them for my use using options. So that's what it is. I'm sure that ETF Profit Driver will go back on the market, and when it does, I'll certainly let everybody on the email list know about it. And I'll certainly, you know, do whatever I can at that point in time to, you know, make, you know, add value. And that's what I'm trying to do with this presentation tonight, is add additional value to the course that you're buying. And because I imagine that there's a number of people out there that like the way Bill outlines, you know, how to trade ETFs, but would like to do it with options. And the reason is, I mean, there's a lot of reasons, but one of the reasons is that you know, if you're trading a $5,000-$10,000 account, let's say you have an IRA it's got 5 or 10 grand in it, it's pretty hard to trade you know, stock positions in there with good risk management, because you're exposing, you know, it takes pretty much all your capital. You're in one position. You can't really diversify well, etc. Lindsay says thank you. Well, thank you, Lindsay. I'm glad you appreciated the presentation. Question. So is covered call using option is better or calendar spread? Covered call using option better? Well, covered call is stock. You own stock, and then you're selling a call against the stock. Calendar spread is different. Remember that stock is not equivalent to a call option. You have different things going on there. Don't confuse calendar spreads and covered calls. There's a tendency to do that. Covered calls are not better than calendar spreads. Calendar spreads are not better than covered calls. They're different trades. If you want to trade a covered call, great. If you want to trade a calendar spread, terrific. But just understand that they're different trades. They need to be managed in a different way. If you try to manage a calendar spread like a covered call, it's not going to work, and vice versa. So different trades. Make sure you understand that. And follow-up question to that, I mean related to this trend trading using a call. I'm not sure what that means, but hopefully I've addressed it. If not, hit me with another question. Ira says, Chris, excellent webinar, very informative. Thanks, Ira. Thank you. Thank you for joining us. I'm glad that you enjoyed it. I like this feedback. It makes me feel good. Carl says, nice presentation. I'll be looking for your future offerings. Thank you, Carl. I mean stock replacement, covered call, and calendar spread. Well, if you're looking to, I'm not really sure what you're driving at here. Stock replacement, covered call, and calendar spread. Maybe what you're, all right, if what you're trying to do is say, I want to trade a covered call, but I want to replace the stock with a call option. Again, earlier in the presentation, we went through the analysis of synthetic stock and explained why synthetic stock and call options are just different things. They're different animals. So, there are people out there who talk about, and this is especially true with leaps. People say, well, let's do a leap covered call. There's no such thing as a leap covered call. Either you've got a leap or you've got stock. If you've got stock and you're selling call options against it, you're trading covered calls. If you've got a leap, a call option, a leap call, and you're selling calls against it, you're not trading covered call. You're trading either a calendar spread or a diagonal spread. They're different things. So, in the context of what we did tonight, we didn't talk about covered calls at all. We talked about using call options, how to adjust them, how to manage them, and as part of that management, you are talking about jumping into other types of positions like call calendars, like bull call spreads, using things like bear call spreads, etc. Carolyn says, thanks. You gave a very organized, informative presentation. Much appreciated, Carolyn, thank you very much. Carl says, please alert viewers that the sound is via a different channel at the outset, as opposed to the way TOS handles its seminars. Thanks, Carl. Yeah, I try to do that, and I'm going to try to find better ways to do that. I wish I could do it like Thinkorswim. Thinkorswim has a bigger budget than I have. I've looked at a lot of different webinar platforms, and like all things, there are trade-offs involved, and so this is the trade-off: is that instead of having it all on the internet, which would have been my preference, we had to kind of go a little bit cheaper route, although this was not all that cheap. So I've actually spent quite a bit of money to make sure we have a webinar platform for this year. I think I've run out of questions. If anyone has another question, go